guys. Checking the mic. Hey guys, welcome in. I'm just going to set up the TikTok live stream real quick and then we'll hop in. Continuing from yesterday, I'll give a quick update on what we did yesterday and then we'll run through the rest of the 10K. So chat soon. Okay guys, welcome in. Hey, to everyone on TikTok, this is also a live stream happening on Twitch where you can see my screen. This is the second session of walking through a live discounted cash flow model for Brooks Automation. So if you guys are live on TikTok right now, I recommend that you jump over into the bio of our profile, go to our Discord, and from our Discord you can hop into our Twitch live stream that's happening right now. So we've got a couple people in Twitch. So I'm recommending everyone on TikTok to jump into Twitch. You can still hear the audio, obviously, of as I'm walking through the 10K and building out the building blocks of our discounted cash flow model. But it's probably a lot better for you guys if you can see it live as we're doing it here on Twitch. So go ahead and jump over if you guys are on TikTok. And if not, definitely no problem if you just like to listen to the audio. Okay, so we're going to go ahead here and get started. I'm going to open up what we worked from yesterday and do a quick run through of what we did. So what I'm opening up here is the Excel file. I dropped it into our Discord chat yesterday. It's going to take a second to open. Also going to get Chrome open as well. We're also going to head back to bamsec.com if you guys are following along live. And on BAMSEC, we're going to go back and find the 10K for the 2020 fiscal year for Brooks Automation, ticker BRKS. They trade on NASDAQ. For those of you that weren't here yesterday, Brooks Automation is a semiconductor manufacturing automations business that has also found some synergies selling similar solutions into the life sciences industries, specifically around the storage and cleaning of biological samples. So they seem both really interesting from the perspective of being able to cross-sell a similar process into two very different industries, but also are pretty well aligned over the next couple of years to deal with the significant shortage in supply for semiconductors. So a buddy of mine recommended that I look at this business, so I figured I'd knock two birds with one stone by also using this as our educational tool. For everyone on TikTok, I should probably also drop a comment here that we're going to Twitch, but for recent joiners, this is a live stream in Twitch where you can see what I'm doing on my screen. So we're building a live DCF for Brooks. And I will go ahead and walk through what we did yesterday. Okay, great. Now we're here in item 1A. This is where we left off yesterday for those of you following along on Twitch. Page 12 of the 10K. So what did we do yesterday? Yesterday, we set up the Excel file. So this is just a cover for the model. Generally good practice when you're starting a model, writing the author, date, what the company you're building is, any other information. This is going to be a legend for what will be color coding different cells as inputs as hard codes, assumptions, references to other sheets, references to other workbooks, etc. It's always good to have a legend in the front, but generally these color codes are pretty standard across the investment banking and private equity industry. So blue is for hard-coded numbers, inputs into the model. Black is for in-sheet calculations. Calculations that reference other sheets are typically green, and calculations that represent other workbooks are typically purple. Some investment banks, like JP Morgan, for example, also use purple when pulling in data from finance data providers like FactSet or CapIQ. So that's the color scheme there. We didn't talk about that yesterday, but what we did do yesterday is we started going through the 10K. We talked about how a 10K is organized, specifically focusing on parts 1 and 2, but that's items of business through the financial statements and the notes to the financial statements. We will go through, hopefully, items 2 through 8 today in the 10K. So that's, well, item is actually 1A through 8, so risk factors through financial statements. And we noted down, so this is typically what I do before I jump into actually modeling. I make sure to do a thorough read of the 10K, and here I've been taking down things like basic shares outstanding, where to find those items, how is the business organized in terms of operating segments, how large is the business from an employee's perspective. We took down some notes on backlog, recent M&A transactions, and they provided us with a list of competitors at the end of item 1. And so now we're just about to jump in, do a live reading of item 1A, which is risk factors. This is a rather exhaustive list from, someone on the Twitch account name is GenInvest. You can find us also on Discord. I recommend clicking the Discord link in the bio of our profile and then heading over to Twitch. And so we're jumping in here to item 1A, risk factors, as I said, exhaustive list of risks that management dishes out, and ultimately it's the job of the analyst to identify the risks that are both most important and most specific to the business at hand, right? So there are some risks that you will have a hard time diversifying away from, such as interest rate risk. Anyone that carries loans that have a fluctuating interest rate risk, such as LIBOR plus some spread, are going to be exposed to that. But in semiconductors, for example, I'm sure there are all kinds of supply chain specific risks, although Brooks Automation is specifically in the business of producing the machinery and automated processes to build semiconductors, not in actually building semiconductors themselves. So great, now we're going to jump into risks, and I'll, over here in Excel, add in another section for risks. I'll also kind of talk through live of the Excel shortcuts that I'm using so that you can start thinking about getting good with those as well, because that's really a key to being able to model quickly. So here I'm using Alt-HIR to create some new cells. If you highlight a series of rows, like 3 rows, and then do Alt-HIR, you'll insert 3 rows instead of just 1. So that's a quick way to just create some space in the model. I also noted yesterday I placed these X's here to help navigate through the sheet. So pressing Control down can skips to the next available cell in that column or row. So if I'm at the bottom here and I hit down, it'll take me to the end of the sheet. So this is just a really useful way to quickly navigate through different cells. Great. Copy this. Call this risks. Okay, awesome. So let's jump right in. All right, you should carefully consider the risks below, blah, blah, blah. This is a pretty standard statement. So they're starting with risks related to the COVID-19 pandemic. All right. All right, so predominantly mentioning supply chain risks as factories shut down in various countries that are important to supply chain. Okay. Should take a note here of anything that forced changes in contract as a result from the pandemic. I think that's the most potent one here. So this is perhaps going to be discussed in item 7, management discussion and analysis. So that's going to be a very important section. Go ahead and link this. Yesterday we talked about linking in DanSec. It's technically a premium feature in BAMSEC, so don't worry about that. But if you're working on a team or in an investment bank that uses BAMSEC, it's important to link different things that you're modeling or adding to any presentation or work from BAMSEC so you can find exactly where it is. This is just macro risks to the semiconductor industry. They may face competition, which may lead to price pressure. Yeah, duh. In terms of product orders by customers, changes in demand for the mix of product timing and market acceptance. Timing and ability to reduce our costs in response. Pricing pressures. Yep, so all of this stuff feels pretty standard. I think what we'll want to focus on Okay, interesting. So first, during the fiscal years ended September 30, so they end their fiscal year in September 30, by the way, for those who are new. And the majority of revenues are derived from sales outside of North America. Okay. Proportion of their sales to customers in China will continue to increase. So that's a potentially very significant risk. An American company selling into China, if the U.S. is going to regulate Chinese-owned businesses like ByteDance and TikTok, then why won't China potentially do the same to the American semiconductor automation manufacturing industry? Okay, so maybe doing some reading on specifically Chinese involvement in American semiconductor manufacturing. Yeah, here are tariffs and international trade barriers, although hopefully this does get better in the coming years. Government currency control, they're just rattling off concerns from the Chinese Communist Party here. We're going to see if there have been any questions so far. All right, someone just asked why I use BAMSEC as opposed to SEC.gov. I personally just think BAMSEC, so BAMSEC has everything that SEC.gov does. I just think BAMSEC has a cleaner user interface. And it's easier for me to find the statements that I'm looking for. I don't have to go through this kind of, feels like an antiquated search tool for SEC.gov. But BAMSEC also has a series of really cool premium tools, which we'll hopefully get more experience with at the end when we're taking down all the financial statements of Brooks. But for one, it lets me link to specific places in the 10K, which I really like. Okay, so now there's some specific risks related to acquisitions, integrating operations. Yeah, so this is kind of my first question here was, is the Genuiz genomics acquisition really as synergistic I realize I haven't been linking here for the last couple of minutes. Pop that here. For those of you on TikTok, this is a live stream on Twitch. So go ahead and jump in with our stuff there if you want to see what's happening with the screen share. You could also just see how they funded their, I haven't seen their cap structure yet, but it looked like they did the Genuis acquisition, something like $675 million all cash. We took the note down here, didn't we? Yep, 675 million. Oh, that wasn't Genuis, Edwards Vacuum. So, guessing they took out some debt to do that. Part of their growth strategy, continue expanding within our scientific sector. Okay, changes in key personnel could occur. Okay, I think that's actually a good point. So, top employee skills required. We'll do some research here. Fail to protect your intellectual property, you could list. I think IP risk with regards to China is probably also, I can drop that in here. The addition of our patents over time could lead to an increase in competition and decline. Infringement, third-party property. Unexpected events could disrupt some storage operations. Alright, here, unexpected events including fires or explosions at our facilities, natural disasters, tornadoes, etc. So this is a pretty good example of what you'll find in every 10K ever. We probably should not be, given that they are operating in 50 different countries and have labs all over the place, we shouldn't really be underwriting any specific earthquake or explosion risk. Okay, what raw materials are you guys dependent on? Key raw materials not used in our products and various manufacturing supplies. We use our access to remain universally affected by all the. Okay. I'm interested in what those raw materials are. And alt HR to create some new rows. IT and facilities management is outsourced. May be susceptible to cyber incidents. So I noted this as another example of something that's going to be in any 10K ever. So unless you're looking at a business like SolarWinds, whose business is cybersecurity, or one that would potentially be extremely threatened by a cybersecurity breach, that's something that you'll kind of see anywhere. Business relies on certain good information. Okay. Goodwill and intangible assets may be impaired. Okay, here's a quick note for an accounting lesson. So goodwill is effectively the price that is paid in excess of the fair value of the assets in any business that gets acquired. So for example, we've got 4 businesses here, 2 acquisitions that happened in semiconductors and 2 in life sciences. So they paid, for example, maybe they paid here $675 million in cash for Edwards Vacuum LLC, Edwards Vacuum LLC on their balance sheet, I'd be willing to bet that the fair value of that business was less than $675 million, but when you're acquiring a business, you need to pay what's called a control premium, as well as a premium for any intangible assets that don't necessarily show up on the balance sheet. So assets are typically recorded at historical cost. And so when we talk about IP that's developed internally, like a patent for some new process, if that is completely developed internally, effectively some of the only costs that get capitalized is the patent filing fee, which means that the balance sheet doesn't necessarily truly reflect the value that that patent may have for the business. However, when another business then were to acquire the business that created that intellectual property, they will need to pay for what that value is, but that then gets pulled over into either intangible assets or into goodwill. So another great example of this is the Coca-Cola brand, right? This was developed internally, that is not reflected to the extent that it is worth on the balance sheet, but if somebody were to acquire Coca-Cola, they would need to pay for that brand value, and that would then be put into goodwill on the acquirer's balance sheet. So that's how goodwill works. So what they're saying here is we made a series of acquisitions over the last 3 years. Through acquiring through acquiring these businesses, we accumulated some amount of goodwill and intangible assets that we paid for. It could be that we overvalue these businesses upon acquiring them, and then maybe at a future date, accountants decide that the assets that we acquired are not as valuable as we thought they were, and therefore they need to be impaired or written down. And that will cause both an expense, an impairment expense, as well as a loss of assets on the asset side of the balance sheet. And then that balances in the balance sheet via the expense that then flows into retained earnings. Okay, cool. Change in tax rates or tax regulation. Cool. We will probably do a little bit of a political read. What are Chinese / other major markets tax rates? National trade disputes, we already got that under one note. Subject to numerous governmental regulations, I guess more so in the life sciences segment from the FDA. Dodd-Frank Wall Street Consumer Protection Act imposes disclosure requirements regarding the use and components of our product, conflict of minerals, mined from the donor ground. Okay. Currency exchange risks, indebtedness. Okay, great. Now we get some loan information. So we will actually start taking this down high level. A separate note here that I'll call capital structure. So we'll see how this business is financed. So cap structure. Okay, so October 4th, 2017, entered into a $200 million senior secured term loan facility with Morgan Stanley, JP Morgan, Wells Fargo. As of September 30, 2020, the outstanding term loan principal balance was $50.4 million, excluding unamortized deferred financing costs of $0.4 million. Got it. So deferred financing costs are effectively when the business is raising this debt, they pay a financing fee to the banks that gave them that debt. Sorry, people are freaking out on TikTok. We're on Twitch. Join over to the link in the Discord and jump into Twitch. So when a business raises this debt, they pay a fee, a financing fee to the banks that raised that debt. And so it looks like they paid a financing fee of $400,000 to receive this term loan of $200 million. And what usually happens is we amortize this financing fee. We haven't specifically talked about amortization yet, but this is also something that's paid upfront, typically, and then is effectively a prepaid expense that gets amortized on the income statement over the next however many years of the lifetime of the loan. The term loan matures and becomes fully payable October 4th, 2024. And as described in the credit agreement. For further information, great. We'll learn more about that in the note on debt. But for now, we'll just write here. Entered into 200 million senior secured term loan on October, 4th, 2017, with maturity in so this note matures, it's fully payable October 4th, 2024. Okay, and senior secured means that the debt is senior, so it is one of the first things that gets paid out if the business were to go bankrupt or liquidate. Definitely before equity holders, before preferred stockholders, before any subordinated debt, and this 200 million is also secured by assets of the business. So that means if they don't have the cash on hand to pay for this senior term loan, then it's secured by, they have a series of factories and equipment that would then either be dished out or sold off to fulfill those obligations. Okay, they don't tell us what the interest rate is just yet, but that's okay. Great, now there's some concentration risk. Expected. So, they say sales to our 10 largest customers amounted for approximately 33%, 28%, and 34% respectively of their total revenue in the fiscal years ended September 30th, 2020, 2019, and 2018. So, top 10 customers represents about 30% of revs. That's pretty decent. I think they probably have some more diversity on the life sciences side than on semiconductors. I could be wrong there, but we'll probably find that out soon. But that's probably a bit better than I was expecting. Cross with one or more of these major customers. I'd want to know what the top customer produces because of the lengthy sales cycle. They will be sold directly to end users, but will be components of other products manufactured by OEMs. As a result, we rely on OEMs to select our semiconductor products from among alternative offerings. Customers generally do not make long-term commitments to purchase our products. Sales of our products are often made pursuant to individual purchase orders or are not under any long-term commitments and contracts. Interesting. Okay. Do not provide any assurance or minimum future sales. Do not prefer any. Okay, that's important. Switch over to the wrong page here. Link this concentration risk. Cap structure. Okay, cool. First little taste of cap structure. Sounds like that's their only term loan, which is great. These guys are doing something like 800 million in revenue. Let's take a peek at their finance. Well, we'll see a little bit, but I think they've got 50 million left outstanding on this principal balance, which I think is pretty healthy. Did not note that down either. Okay. Automation programs. The market price for our common stock has fluctuated widely between a high of 56.69 per share and a low of 22.69. Okay, pretty volatile. I'm sure once we get to a discussion of beta, we'll get to the intuition of, is stock price volatility really the right way to discount future cash flows? That's kind of one of the biggest drawbacks of the capital asset pricing model, which we'll all get to, but just dropping the note here. Indicative of future market value, we may be unable to sustain the value of our investment in common stock. Got it. We may not pay dividends. So they do pay, I think, a regular quarterly dividend of 10 cents per share, but I might be wrong on exactly on the value, but we'll get there. Dividends are cash distributions directly to shareholders. So this means if you own the stock by a specific date, you're entitled to get some exact number of cash dollars or cents, probably in this case, from the business per share. And dividend yield is then just the, I'm just checking the questions here. Dividend yield is then just the value of the dividend divided by the current price per share. Someone asked, can you somehow save the whole live screen for us to watch later? Yes, I am saving these locally to my machine, and I will be doing a voiceover to then ultimately speed up and kind of talk about high level what we're doing here, and then add those to YouTube. Okay, our restated certificate of incorporation authorizes the issuance of shares of blank check preferred stock. Is authorized to issue from time to time without further stockholder approval up to 1 million shares of preferred stock in one more series, and to fix and designate the rights, preferences, privileges of preferred, including. Okay, interesting. Interesting that they note that as a risk, right? Something that the management team is able to do. They're able to issue a blank check of 1 million shares of preferred stock. That this gets to like the fundamental governance issue that the people who own the business aren't necessarily, well, management has a stake in the business, but they're not the ones like they don't own the full business. You as shareholders of this public company do, and so this is why we have this auditor management relationship, and also why you have activist funds, so that you can have shareholders that impact the operations of the business, right? So it's interesting, I find it somewhat funny that they list here as a risk that the management team has the right, without further stockholder approval, to issue up to 1 million shares of preferred stock. But this is important. Preferred stock is really more of a debt item than an equity item. It's something that gets paid a regular dividend, and likely won't swing as widely in value as common equity. But this is important, just given that to write blank check of 1 million preferred shares, also called prefs. Great. Okay, cool. All right, now we're going to jump into item 2, properties. Oh, before we do that, item 1B, unresolved staff comments. This is a super important section, and it's blank, as it should be, or it might say none or not applicable. Unresolved staff comments is the section where if the business in this filing or in previous filings got responses from the SEC that they did not resolve, goes here in item 1B. And that's typically a really big red flag. As a retail investor, if you're not comfortable going through 10Ks and you see a unresolved staff comment, unless you can very clearly identify and understand what that staff comment was made for and that it's not a significant risk, don't invest in the business. This is a really big red flag if there are unresolved staff comments. But here it's blank, which is great. We can just continue moving through. All right, so here, item 2, properties. These are all properties that are owned and leased by the business. So it looks like they have here their corporate headquarters in Massachusetts, and that's owned. Something else in Indianapolis, Indiana. Interesting. Sample storage, sales, and support. Eli Lilly and Roche both have big headquarters in Indianapolis, so I'm guessing those are probably pretty big company, pretty big customers on the side. And a laboratory in China and another one in New Jersey. Okay, interesting. Lease expiration June 2021. Okay, so the Chinese laboratory expiration June 2021. Let's write that down here in properties, because I think the question is going to be, is that lease going to get renewed? Are you going to continue running laboratory operations in China? Okay. Properties. Sorry, it's probably the more correct word. Okay. All right, legal proceedings, exciting stuff. All right, item 3, we are subject to various legal proceedings, both asserted and unasserted, that rise in the ordinary course of business. They can't predict when these happen, yep. However, as of the date of this report, we believe that none of those claims will have a material adverse effect on our consolidated financial condition or results of operations. That's fantastic. For someone that's in the semiconductors and life sciences industry, not to have any material claims that they think are going to either actively go to court or be settled in some way that's going to require a provision on their balance sheet is great. That's great. That's a great sign. Item 4, another really funny 10K quirk here, mine safety disclosures. Every business, every public business in the United States needs to file item 4 on their 10K, mine safety disclosures. It's exactly what it sounds like. This was some quirk of a law in the 20th century that required everyone, if they operated a mine or had some part of their operations relevant to operating a mine, to report that these mines were being operated safely. So I always find that funny that still exists in our 10K reporting. Okay, some basic information about the common stock. 515 holders of record. Holders of record just mean not any holder, just someone who holds a significant stake in the business. Dividends are declared by the board of directors. They intend to pay quarterly cash dividends in the future. The amount and timing of these dividends may change. So for example, a big activist investor, Loeb, asked Disney to stop paying their recurring dividend, which was something like $3 billion a year, instead to reinvest it into their streaming services in this environment. So dividends might catch some flack in the COVID environment. If businesses are getting squeezed on the balance sheet, why are they paying more cash directly to investors, and they should instead use it to reinvest or keep their employees on board? But sounds like these guys have been pretty good with cash management, are also on the right end of some dynamics around semiconductors, so that shouldn't be too much of a worry. But here, great. So we can let's put this down also in cap structure. Dividends. So they pay a dividend of 10 cents per share. Quarterly dividend payable on December 17th, 2020. Okay, so to explain here quickly how dividends work, you'll notice here that all dividends have an approval date, which happened here on November 5th, a date that they will be payable here on December 17th, and a date of which they make the list of the stockholders of record that will be paid that dividend. So if you held the share on December 4th, 2020, you'll be added to a list that will then receive 10 cents per share in a cash dividend. So that's how the dividend announcement, payable date, and payment date happens. So here, dividends, cents per share, quarterly. So we'll do a dividend discount model as well, which will mean we'll make some assumptions around the future payments of dividends, probably be that they're paying this 10-cent dividend into perpetuity, and we'll discount that dividend value as well to get to an implied value per share. So we need to add this dividend as well to our DCF calculations, because not all businesses pay dividends, but these guys do. So just noting that there. Assuming reinvestment, and they also assume reinvestment of dividends, which we can also do, probably we should do. Meaning that the dividends that they pay, the 10 cents per quarter, then are used to buy more shares in the business. Nice. So Brooks says just consistently outpace the NASDAQ and its peer group. Semiconductors, obviously, and life sciences are hot industries. leading the NASDAQ. Okay. Issuers' purchases of securities, approved a share repurchase program for up to 50 million of the common stock. Timing and amount of any shares to be repurchased under this program will be based on market and business conditions. There were no shares repurchased under this program during the fiscal year ended September 30, 2020. Interesting. Okay. Yeah, I mean, that makes sense, right? Like, these guys have seen strong share price performance. So why do we do share repurchases? What's the thesis? It's that if a management team believes that the current share price of the business is undervalued, they can put cash toward buying those shares back on the open market, which should then, in theory, be a valuable exercise to the business. So by taking out more shares from the open market, you're retaining the same equity value. You're taking out cash, you're taking out equity value, but you maintain this value for the business for a lesser number of shares, which means that the value per share should therefore reflect share repurchases. Okay, great. Now we're in item 6. We're just crushing this 10K. So item 6 is selected financial data. We're now going to jump into high-level financial data, some stuff from the balance sheets, income statements, some cash flow stuff as well. And then all of these line items are going to get discussed in item 7 in management discussion and analysis. I see we've got a couple new people on TikTok as well. Noting for you guys that this is a live stream happening on Twitch, so you guys can see what I'm looking at on my screen. Just jump over to the Discord link in the bio, and then from Discord, you can jump onto Twitch as well. Okie dokie. Okay. So we're here in item 6, and actually, I'm going to take a quick break. I will be right back, and then we'll jump into... Oh, Peter's here. Sweet. Peter's the dude. He's the main man. Definitely go follow Lifestyle Banker as well. Okay, I'll be right back. We're here at the 40-minute mark. Okay, guys, we're back on this Saturday afternoon. Does anyone know in the Twitch chat what these crowns mean? Oh, Prime Gaming. Interesting. Okay. I guess on the Twitch chat, I'll open it up to if you guys have any questions that I can answer over the next 2 minutes before we jump back into the 10K. Just drop them in the chat. I'll give you guys maybe a minute or two. Alright, I see the Twitch guys are being shy. That's okay. I'll jump back in then. Maybe you guys on TikTok have any questions? Oh, Greer's here. Awesome. So for you guys on TikTok, this is a live stream that's also happening on Twitch. Go to the Discord link in the bio of this profile, and then hop over to Twitch, where you can see what's happening on my screen. Also just got a question here on Twitch, so I'm going to answer that. And then we're going to jump back into the 10K and follow through with item 6, which is selected financial data. Okay, so what would you say are the most important parts of the 10K, which sections, if any? Fantastic question. So when you're reading a 10K, I realize 10Ks are long. Many of them can be over 100 pages and can be very dry and full of jargon. So the most important sections I think you should always read of any 10K are item 1, business, item 1A, risk factors. Then you can jump down to item 6, which is where we are now, selected financial data. These are some high-level financial metrics for the business. And then item 7 is probably the most important part of the 10K, where we'll do probably the most close reading there. This is effectively management talking about the last year of operations, particularly as it pertains to the metrics that they've reported in item 6. So definitely 1, 1A, 6, and 7, and the financial statements in item 8 would be the most important sections. I'd say the quick things that you can just check off in item 1B, unresolved stock comments, like I mentioned, make sure that's blank. And then also in item 8, make sure that the report of the independent auditors firm also is an unqualified statement. And we'll get to what that means as well. So great, awesome. Okay, so let's jump back in here to the 10K. We're here in item 6, and let's do some high-level look at the financials. Okay, so revenue growth. 2016 to 2020, roughly doubled. So that's about a 15% revenue CAGR. That seems really healthy. However, they did do a series of acquisitions. When were these dates? 2018, 2019. Did do a couple of acquisitions in 2018 and 2019, so would be good to get an understanding of how much of this revenue growth comes from those acquisitions. That's called inorganic growth versus organic, actually coming from the operation of the business and reinvesting in itself. My guess is, so they bought this Edwards vacuum business in 2019 for $675 million. Don't know what the multiple that they paid, but $675 million, that there's got to be like at least 50 to 100 million of new revs in there from that business. And these statements are pro forma for that. But I mean, like the historical statements are also pro forma for those acquisitions. But it's would be good to see kind of are the businesses that they acquired growing more than the core business. Gross profit seems like a bit under something like a 40% gross margin. Makes sense. This is seems like something that's really heavy in manufacturing, probably, and a lot of raw materials, a lot of cost actually required to produce these goods. Generally strong and growing operating income. Love to see that. So this is kind of the basis from which we drive cash flows, operating income. So we take EBIT, this operating income, remove tax, add back non-cash expenses like depreciation, amortization, remove cash expenses that aren't reflected in the income statement, such as capital expenditures, and then also cash that's tied up in the business through net working capital, which we'll all get to. But so far, things look pretty healthy. Income loss from discontinued operations net of tax. Okay, will be interesting to see here what happened in 2019. All right. Loss per share, and this is all per share data. So this tells us basic net income per share attributable to Brooks. So this is taking their net income here and dividing this by the number of common stock shares available in the business, which we saw at the front of this 10K. And then diluted net income per share takes the basic share count provided on the front of this 10K and also adds dilution for any stock options, restricted stock units, etc. We'll do that exercise in this DCF because we do want to get to what's called, quote, fully diluted share count when we're dividing the total equity value of the business to get to a value per share. The theory here is effectively like there's a number of basic shares that are outstanding, but there's also a bunch of stock options and restricted stock units that are sitting in the business that management and key employees can then vest, that will be vested and then exercisable, which will then add effectively more shares to the business without creating any new equity value for the business. So restricted stock units are effectively just stock options with a strike price of 0. If you guys are familiar with the way stock options work, we'll talk about all that when we get to that part of the analysis, but we don't need to do a deep dive into stock options right now. Okay, history of cash, generally really healthy cash build. They've got $300 million in cash as of 2020 and something like $50 million outstanding on their term loan, which is great. Like, so they can cover their term loan 6 times just with the cash on hand. Working capital. So working capital is a measure of how much cash is tied up in the business. You'll see the little highlights here of 3 and 5. This means that it's discussed in notes 3 and 5 to financial statements. This stuff like how much cash is tied up in inventories, accounts receivable. Are they able to delay payments to vendors via accounts payable? So you can have a negative working capital balance, which usually indicates really strong cash flow dynamics. These are like Walmart, for example, is really good at delaying payment to suppliers and receiving payment before they actually pay a supplier for an item that they've sold. But here they have a positive working capital, also makes sense. So what they've done here is probably just a simple calculation of current assets less current liabilities, but also removing any financial assets from current assets. So that's stuff like cash and marketable securities, as well as any financial obligations from current liabilities, such as the short-term balance on their debt obligations. So, okay, total assets, nice and cool. Wow, that's a big equity cushion here, guys. So they have very little liabilities on their balance sheet. Interesting. Okay, I'm excited to see their balance sheet for the first time. Quarterly revenue. We said the business is cyclical. Doesn't look that looks like a bit of a fourth quarter focus. That didn't happen in 2019. You know, this could just actually be organic growth throughout the year. That's just my very uninformed knowledge of the semiconductor industry, though. So I'll have to do more look into that. Maybe they see a bit less variety from the life sciences segment. I would think that genomics and pathology work happens pretty consistently throughout the year, so maybe that's helping. Okay, cool. All right, so in the fourth quarter of 2019, they had something interesting happen, and we'll take a look at that. Oh, cool, they provide some notes here specifically to this data. We make acquisitions from time to time. Selected data includes the operations results from these acquisitions and the results and dates. Please refer to the note. Okay. Operating income loss and net income loss includes a charge of $76.5 million during the fiscal year 2016 to an additional valuation allowance against our U.S. net deferred tax benefits. Got it. Okay, that's stuff from the new tax plan. The calculation of working capital excludes cash and cash equivalents and marketable securities. So this is just what I was noting on net working capital, that they're removing financial assets from current liabilities. And so they consider their financial assets to be cash, cash equivalents, and marketable securities. I would assume that's the only financial assets that they have. Doesn't look like they have any long-term investments, for example, on the balance sheet, but those wouldn't be current anyway. Let's say when we entered an agreement to sell our semiconductors, here. Okay, so this is where they got their net income bump. They sold their cryogenics business, cryogenics business, resulting in a net gain of the sale of $408.6 million. Awesome. The taxes payable of approximately $95 million. Okay. Awesome. Now we're in item 7, management discussion and analysis. We'll probably close out with this section, and then the next live stream, we will jump into item 8, the financial statements, download the financial statements, organize the financial statements, and reformat them for our purposes here. So we've got something like another 10 pages of, and this is going to be pretty close reading here because we want to really get into the meat of what happened in the last 12 months. So, great. We read the notes. Here we are in item 7. All right. Cool. Awesome, guys. We're doing well here. The gain of 408.6, 409 in Q4 2019. All right. I'll take down some notes for management discussion and analysis, arguably the most important section of the 10K. All right. Everything's good here. Just checking in quickly on the Discord. Cool. All right. Back to it. All right, so they're going to talk about the last 3 fiscal years. Discusses the accounting policies and estimates that are required to make these statements. Or liquidity and changes. Cool. All right. Leading global manufacturing. The beginning of item 7 will read similar to item 1. Okay, in addition, our new Pure Max Leaf Care cleaning product line to handle the contamination challenges of high identity at the market for EUV. We will continue our investment in EUV pond cleaning and storage. All right, I'm going to need to do some reading on EUV lithography. Fun. Sample management. So this is discussing the Genovese acquisition. This is kind of one of my leading questions. Okay, so their argument is that they can run another hook into customers where they're doing sample storage for them by also running gene sequencing and synthesis for those samples. I guess just gene sequencing for those samples. But okay, and so we want to evaluate the extent to which individuals who pay Brooks to do their sample storage or sample cleaning and maintenance also would pay them to do gene sequencing. Required Row informatics software based in Frederick, Maryland. Row provides cloud-based software solutions to manage laboratory workflow. %of their cumulative research and development spending was focused on innovating and advancing solutions in the life sciences market. Okay, that's interesting. So they're putting more R&D expenditure into their semiconductors business, I would think, particularly as a percentage of revenue, right? So 29% goes to 43% of the business, which I assume then the other 71% goes to the semiconductors business. I guess we'll confirm that, unless they have some different new ventures going on. R&D expense goes to the life sciences operating unit. I guess they say more again, but probably close to it. Continue to develop, we have complete lineup. Oh, I think I got an acquisition completely wrong. So they entered into to sell their semiconductor cryogenics business to Edwards Vacuum, member of Atlas, approximately. Originally acquired in 2005 as part of the Helix Technology Corporation, classified, discontinued, otherwise. So let's edit that here. We misread that. Excludes $6.3 million retained by the buyer at closing on an estimate of net working capital adjustments, which are currently pending finalization. Net proceeds from the sale were $531 million of taxes and closing costs paid, and remaining taxes payable as part of this will be transferred. Our intellectual property, not our got it. Cool. Okay. So they sold off this business to extinguish their term loan. I guess that wasn't the full picture of debt that we read earlier. They probably had another loan that's just completely paid off. All right. Do you have another discussion of segmentation? Now we're talking about operational results. 2020 versus 2019. Gross margin improvement. Okay. Restricted cash was $305.7 million at September 30, 2020, compared with $342 million on September 30th, 2019. CapEx, $15.7 million for acquisitions. Okay, so these are small acquisitions, and $29.5 million for dividends. Partially. Okay, so the annual dividend is worth about $30 million. So we have adjustments to net income for non-cash items, 91 for taxes paid on the gain, and cash changes the prior fiscal year. Proceeds from the sale of the business, cash inflows of 9, partially offset by 2 acquired generators, cash outflows. Okay, so they sold off the cryogenics business, acquired Genuiz, and also paid off a good amount of debt. I think that's generally healthy. That's technically not then R&D expenditure to acquire Genuiz. So I don't think that's captured in this 29% number. Related to principal payments made on the proceeds received from our term loans, cash dividends paid of 28.9, capital expenditures of 23.9. Cool. All right, now we talk about some accounting standards. So there are choices that management can make, particularly about how you recognize revenue, how you send inventory out in sales, and so we learn how what decisions they've made around accounting here. Revenue. Most of our sales agreements contain standard terms and conditions. Certain agreements contain multiple performance obligations or non-standard terms and conditions for customer contracts. More than one performance obligation, we allocate the total transaction consideration to each performance obligation based on the relative standalone selling price of each performance obligation within the contract. Okay. So we recognize revenue as work progresses based on a percentage of actual labor hours incurred on the project to date and total estimated labor hours expected to be incurred on the project. Okay, interesting. That's actually, I don't know if that's standard in semiconductors, but that's definitely not standard generally, right? Like usually you recognize revenue when the good trades hands, and here they're recognizing revenue as a percentage of work hours spent on the project. To measure progress requires judgment. I think they have such a significant sales cycle and such engineering resources required to close a sale that they feel it's right to do this way. This could be pretty standard. I'm definitely very ignorant here. Well, profit estimates of long-term contracts based on the total revenue expected to be generated. Yeah, so this is an important point, right? That like, say they're working on a bunch of different projects and they're recognizing revenue as they're completing these projects, but the good hasn't actually changed hands and they haven't received the cash for those projects. Yeah, potentially they're in a world of hurt, but that's a small risk, I think, because there's just so much demand for semiconductors automation at the moment. Revenue recognition, % of labor hours completed. All right, using the purchase method of accounting. All right, great. So here's just a reaffirmation of the Goodwill lesson that I provided earlier. So here, the assets acquired and liabilities assumed are recorded at their respective fair values at the acquisition date, but of course you're paying more than just the fair value of assets. Instead, you're paying some premium for the business, and that premium is going to be captured in Goodwill. So Goodwill represents the excess of the purchase price over the estimated fair values of the assets and liabilities acquired. Judgment is used in determining fair values of assets. Fair value. So, for example, here on the Genuis acquisition, this is the genomics synthesis and like genomics testing business. So these guys, for example, each patent that they have that was developed in-house by Genuis, management had to do a forecast in revenue for what they're going to get from these patents in the future, and that is then going to be recorded as the fair value of the asset when they acquire it. But say a brand new technology comes out that replaces the patent value that Genuis had, then that asset needs to be impaired, and that would be a loss for the business. That would be an impairment cost. To you guys on TikTok who are also listening. So we'll do some work specifically around the valuation exercise that was the Genuis acquisition. Intangible assets other than Goodwill are valued based on estimated future cash flows and amortized over the useful lives. Goodwill is tested for impairment annually or more often if impairment indicators are present at the reporting unit level. Goodwill impairment tests. Good. We have 3 operating and 3 reporting segments. Brooks Semiconductor Solutions, Life Sciences Product, Life Sciences Services. We have 6 reporting units, including 3 reporting units within Brooks Semiconductor Solutions. 1 reporting and 2 reporting units in Brooks Life Science Services. Okay. April 1st of each fiscal year, so it's coming up. Stay tuned for that. Okay, so they also do a DCF, discounted cash flow method, to determine if impairment needs to take place. Or not, well, they decide if impairment needs to take place, and if it does, then they value those assets with a DCF, which is what we'll build here. Projected free cash flows and the terminal value discounted to their present values. Yes, yes, yes. So read this if you want to get a quick high level of what a DCF is. We don't need to do that now. Judgment based on market commercial. It would be good maybe if they provide what these DCF assumptions are. Our annual Goodwill impairment test as of April for 6 reporting units. No adjustment to Goodwill was necessary. Neither was in 2019. Great. Restate inventory at the lower of cost or market amount, and make adjustments to reduce the inventory cost to its net realizable value by providing estimated reserves for obsolete or unmarketable inventory. Okay, cool. So they create inventory at some cost. If the market value of that inventory is less than that cost, then they will impair it to that market value. Periodic reviews of our inventory. We compare on-hand inventory. Recorded valuation allowance to reduce our deferred tax assets. The amount. We'll get into deferred tax assets and deferred tax liabilities in the future, DTAs, DTLs. This is effectively like, for example, for significant R&D expenses, you can get tax credits, and it can be applied as deferred tax assets. So it's something that can effectively be used to pay taxes when they come up. Stock-based compensation. We'll also use this to add back non-cash expenses in the operating portion of the cash flow statement. So businesses can pay their employees in stock as opposed to cash, and that means we need to add back that expense on the income statement wherever it was used to pay employees. All right, this is 2020 compared to 2019. We've got like 4 more, 5, 6, significant more pages here. I may take a break here. I'm getting kind of hungry. We are where in 10K? Here, we're in results of operations. Boom, page 36. Okay, put that down. Okay, someone just asked on the Twitch if I have these recorded. I do. I'm saving these to my local machine, and I'll be doing a voiceover of these videos to kind of walk through them more quickly. I'll probably play them in like 2 or 3x. But yeah, these will be recorded. Maybe you guys are making clips. So great. I'm gonna take a quick break. Honestly, maybe we pause here, hour and 20, and kind of roll through the rest of item 7 and item 8 tomorrow. And then yeah, so we're pretty much almost through the pieces of the 10K that we'll be reading. For writing the DCF. The rest is just the rest of this item 7, item 8, and notes the financial statements. And sorry, my roommate's also just arrived, so probably it's good timing to shut this down. But thanks to everyone who pulled in, and we'll probably continue this for another hour tomorrow, and also quickly chat with the TikTok guys as well who are still there.